Welcome everybody. This is George Veter Financial, talking to you in the middle of November as we're ramping up into the holiday season. First, to kind of catch us all up to speed so that we're all thinking the same thoughts, we had a difficult summer, didn't we? As was expected, we had the market start to weaken the second half of August, and that accelerated into September. And in my last vodcast, I talked about that. September historically is the weakest month of the year, and it didn't disappoint us this year. The market was down approximately 5.5% for the major indexes. And then usually the market will pick back up in the middle of October. This year that was delayed a few weeks, I would say, because of the war in Israel, in Gaza. However, we had kind of a difficult moment that extended longer than it typically does because of geopolitical pressure and headline risk is what I would call that. October 27th, the market took back off again, a couple weeks later than we typically see it take off. But it took off, and we're up 5.6% as of me checking the Dow before I started on this vodcast. And it's happened in pretty quick succession. We went from 32.5 to 34.5 on the Dow, thousands which is a significant move. And now we find ourselves in the best time of year for stocks. Historically, back to World War II, we do the best in December, second best in November, and third best in January. So that rolling quarter that we're just on the brink of is when we make most of our money for the year historically. Things can change every year. That's why we don't try to market time, but we learn from seasonal patterns and we try to exploit that and take advantage of that and rebalance our portfolios based on those seasonal patterns. We invite clients that have too much cash on the sideline to invest on seasonal weakness. And that, again, it's not a perfect science, but that does give us an advantage if we follow those rules that history has taught us that can be somewhat guidelines. Now, I want to talk for a minute about what has interrupted the market advance. One, the concern over the Fed. The tighter monetary policy that we've been in for a year and a half concerns Wall Street because the more expensive money is, the less of it people tend to spend. So it slows the economy down. As all of us know, that was intended, so that's a consequence that we wanted to happen because we had an inflation scare. So no matter how much money you make, if things are getting more expensive, you feel less prosperous and you tend to stop doing as much economically to stimulate the economy. So the Fed was very aggressive and raised rates from a historic low to now we're in the high fives on the Fed overnight fund rate. Now we paused in November as was expected. We're also expected to continue to pause in December here. And many analysts believe the Fed, barring some adversarial information on inflation that could come, but if trends remain intact, we believe the Fed is probably done raising rates. As far as when he pivots and starts making money cheaper, I don't know. Everybody has a different idea on that and nobody knows the future, but I would say the most common guesses from credible analyst community would be June, July of next year. That could be sooner, it could be later, depending on the flow of inflation rates. Now, beyond the concern of inflation, we also have been concerned about this war, which typically geopolitical stressors like this Israeli-Hamas war, humanitarian-wise, are horrible for us to watch, and it does sour our view of the world and make us all a little bit sad and withdraw a little bit when something horrible happens and we are front row witnesses, especially with social media and all our news channels giving us 24-hour coverage. It tends to occupy our consciousness. I will tell you though, historically, geopolitical issues like the war in Ukraine and the war in Israel are wars that don't last very long as far as the market's impact for those wars. I have in front of me that we will post on our website the geopolitical events that have happened since World War II. We've had 22 of them that we would consider a major event, including terrorist attacks, wars that we've had in this country and other countries, and other geopolitical shocks to the system. I'll give you an example. The most devastating would be Pearl Harbor in 1941, when we were blindsided with the attack on Pearl Harbor, which thrust us into World War II. The market went down which we would expect. It went down at its low point from Pearl Harbor, 19%. Now, we would think it would take years to come back from a devastating hit like that and the world events that followed, but 307 days, less than a year later, we were higher than pre-Pearl Harbor. And that is the longest consequence of a geopolitical hit to the world or our economy. All of the others, including the war in the Gulf, the terrorist attacks in 9/11, have had a much smaller impact on the market where we recovered much quicker than Pearl Harbor. But that was the worst one, and it lasted less than a year. As you can see already, we're seeing the market move on. Obviously, we're aware of the war in Israel. We don't know how long it's going to last. It could be a long one, but the impact on U.S. earnings is minimal, and so the market's moved higher. As I mentioned, 5.6% higher as of the beginning of this vodcast since the low point October 27th in the face of that war. Historically, this is our best time, as I mentioned, in stocks in the fourth quarter, so I think we'll continue to fight forward through the balance of the year. January is typically a very bullish month for the market because of pension flows. You know, we have a new tax year starting January 1. So if you have contributed all you can to your 401k during this tax year, 2023, when 2024 rolls around January 1st, guess what? You can put more money in your plan, no matter what type of plan it is. You have a new contribution limit to meet. So that floods the market with new deposits that have to be put to work in funds, bond funds, stock funds, in the market in general. So that's what we call the January effect, or CNBC coined that term, the January effect, in January. And plus we have earnings season for the fourth quarter that start in the middle of January that carry us through the middle of February. So we have a lot to look forward to. Is it going to be straight up in my estimation? Well, history tells us no, that we kind of zigzag our way up. You know, we take 2 steps forward and 1 step back. I'll just remind you this. We are all suffering mentally from having endured a bear market in 2022. That was no fun. All of us were affected in some way by that. It was a 20% decline from the high, spurred on by a fight against inflation. Now, we had not had a bear market like that since 2008, so 14 years in between. And so it was devastating in a lot of ways. But there is always opportunity that's created in those moments of crisis or difficulty. When I give my referral dinner seminars, I always give the personal history of my grandfather that made all his money in the Great Depression because he saw the opportunity that the Great Depression offered people that wanted to buy real estate at cents on the dollar because of that moment of crisis. And I always tell the story of John Templeton, the founder of Templeton Funds, how he built the original Templeton Fund in the 30s with half those companies in some form that he put in his first mutual fund. He put in about 100 companies. Half of them were in some form of bankruptcy. And that's where he made his first fortune. And then after World War II, he opened up his first international fund, betting on Japanese stocks after Hiroshima, believing that they would rise from the ashes. So history tells us that whenever we have a moment of fear and crisis, those are the greatest opportunities to make money if we're brave. Now, understand it's not always easy to be brave, and that's why you partner with us, so that we can guide you through those times. We can't take away the stress of whatever is scaring people for the time being, but we can be there in your corner. We can give you perspective. We can encourage you. We can make you feel better in a number of different ways, that if you just stay the course, this too shall pass. And what seems to be a devastating time when you should run is exactly the opposite. It's when you should engage for greatest opportunity. Now, I want to wish all of you happy holidays because we're just approaching a fun time of year. We get to spend time with family and reflect on our blessings, especially Thanksgiving. I would make sure that we inventory our blessings and realize all the goodness that we have living in this country and the people that support us and love us and understand us. And regardless of what trials we have, if we are cognizant of our blessings, that's where true wealth is. Because if you're grateful, you're happy. And if you're not grateful, no matter what you have, you're not happy. So let's practice that, especially in this holiday that's centered around gratitude, and ramp us up into Christmas. And I look forward to our next conversation. Thank you.